purchase discount. If you still remember what we discussed in chapter 7, we discussed the sales discount. In that part, we are discussing the accounting from the perspective of seller. Now, for the purchase discount, we discuss the accounting from the perspective of buyer. The company is a buyer to purchase the inventory from a supplier. And the supplier provides such sales discount from the seller's perspective, but this is purchase discount from the buyer's perspective. 210 net 30. That means if the purchaser here pay within 10 days after the sales, there will be a 2% off the balance. Otherwise, the full payments will be due within 30 days after the sales. Again, similarly, we can report it using both gross and net methods. The difference between gross and net methods is assumption. Gross methods assume that the buyer does not take a 2% off discount, while the net methods assume the buyer will take the 2% discount. Okay, so the total purchase was $20,000. So 2% of $20,000 actually is $400. That's the total purchase discount. This is a purchase discount from the perspective of buyer. It is also a sales discount from the perspective of seller. If we assume the buyer does not take any discount, so the journal entry will be debit inventory, credit accounts payable, no discount. Under the net methods, we assume the buyer will take all the discount, and the total discount we calculate was $400. So we debit inventory $19,600, which is $400 off of $20,000. Accounts payable is also after the discount. Later depends on the payments. Okay, so the purchase was on October 5th. We assume the first payments made on October 14th, which is during the discount periods. And these payments was paid for the 14 out of 20,000 balance. And the gross methods, this $14,000 will be 2% off. So to account for this discount, we debit accounts payable $14,000. So this actually write off part of the liabilities. Then the actual payments is after discount. The inventory value reduced to 80. This is 2% of the 14,000. The gross method only accounts for the actual discount when there is any. For the net method, since all the discount has been accounted here by assumption, so there's no discount to be accounted for. So we debit accounts payable and credit cash. These are all after discount. Later, on November 4th, that's actually after discount period, but before the deadline. The rest of balance is 6,000. 20 subtract 14. While there's no discount, so for gross methods, we debit accounts payable 6,000 and payments 6,000, no discount. For net methods, we only account for purchase discount that were forfeit. So the payments were 6,000. Okay. And accounts payable was 5,880. Why? Because the buyer in this example only take 280 discount out of 400. In other words, originally we assume the total 400 discount will be taken, but the actual discount was 280. So the amount discount that forfeit was 120. So we will debit purchase discount loss. In some book, it said discount forfeit. Under the net methods, the total discount is difference between the assumed 400 here and the discount forfeit. The balance of assets, the income statement were not affected by these two methods. But net methods again is preferred. The reason is this discount 2%, if we annualize, it is a pretty attractive offer from the seller. And when you learn this part, you can compare with the slides in chapter 7, sales discount, for the comparison. Then you know how the two parties in one transaction, what's the accounting from each party. Okay, so here is on purchase discount net methods. Since it is net methods, so we assume the buyer will take out the discount. The discount is 2% off. Or you can use the total amount purchase multiply 98%, which is 1 minus discount. You get this. Then following this journal entry, you will debit inventory, credit accounts payable for 11,760. In other words, the purchase here is reported as 11,760. Purchase discount gross method. So gross method assume there's no discount. So we just report the gross amount 12,000. So the answer is 12,000.